The CPI report just came out today. We went live for that event. However, I'm here to break it down for you in a very quick summarized video. CPI basically came in as expected, rose 4% year over year, and core CPI rose 5.3% year over year, both in line. However, core CPI looks to be a lot stickier than we'd like. Even though it came in line, I think that economists and analysts were hoping that core CPI would come in less than expected, showing that there was, less of a stickiness for core CPI. However, what does this mean for the Fed? What does this mean for the stock market? Well, if we take a look at the Fed funds futures, we could see that now we are projected at almost 92% probability that the Fed is going to pause. And I think that the Fed is going to pause. Think about this. If inflation is coming down per the metrics that they choose to calculate it by, then what upside would there be for the Fed to raise rates? In my opinion, there is no upside for the Fed to raise rates. There is only downside if they raise rates. They can argue that, hey, inflation is coming down and we are not going to pause. We're not going to pivot. We're not going to cut. However, we can afford a pause and then reevaluate in July. And that's why you see in July, now there is a 60% probability that they do a raise in July. So pause in June, do a raise in July. I don't think, oh, here, let me show you actually, sorry. Here's July, 60%, my big head was in the way. 60% probability that they do a raise in July. Now, in my view, I don't think the Fed is going to pause and then raise again. I think if they pause, they're just going to pause for good. Like that will be the last rate hike. Even at 60%, that is not a huge probability that the Fed does. It's not an overconfident probability that the Fed does a rate hike in July. And the Fed doesn't really have a record or a history of pausing and then raising again. They did this in the early 80s, but those times were very different. We were fighting double-digit inflation. We paused too early. The Fed funds rate even went to 20%. It was a completely different time. I don't think the Fed is going to pause and then raise. If they pause on Wednesday, June 14th, I think that it will remain paused. Now, if you guys have been following my market updates, oh, wow, AMD is going down. We just alerted AMD. However, it didn't get to our entry. Anyway, that's neither here nor there. If you've been following my market updates, what have I been saying? I've been saying that an agreement on the debt ceiling would take us to 4,300 on the S&P 500. We hit that 4,300, and a pause would take us to around 4,500, between 44 and 4,500. And I'm still of that belief. Now, could the S&P 500 see a pullback after that, or the market in general? Yes. Let's take a look at why that is. Because if we take a look, the S&P 500 just made bull market territory, meaning we went from a bear market down here in October 2022, was the bottom of the bear market so far, to where we are now is an increase of 20% or more. So we have just crossed into bull market territory. And if we look at this historically, the results are actually rather mixed as to what happens next. And, you would expect that after we cross into bull market territory, that we remain in a bull market for the foreseeable future. However, results have been kind of mixed. But I would say that after World War II, every time that we went from bear to bull, for the most part, 6 months to a year later, we are green. There's only been a couple of times that we haven't been. And even then, it hasn't been that drastic of a drop, thereafter. But you could see that in the short term, it's actually very common to see a pullback, between a 5 to 10% pullback. So I do expect to see a pullback at some point. There has to be a cooling off, especially if we're taking a look at these imbalances here. We could see resistance around that 4,500 range, but I do think that it is very likely that the S&P 500 gets there. And one more thing, and I brought this up as well on Twitter. Follow me on Twitter, by the way. I post daily free finance and trading content. You definitely want to follow me on Twitter and Instagram. But I was saying that if the S&P 500 gets above the golden pocket here, it is unlikely that we will see these October lows ever again. that's it. It will be very unlikely if we close above here, in my view. We could close below this golden pocket, which is a Fibonacci number, but I think it will be very unlikely that we get below the October lows if we close above here. Every single bear market in history, going all the way back to the dot-com crash, going all the way back to 2008, this has been the case, that after we cross the golden pocket, that we don't see the bear market lows once again. And you can thank earnings for this. Earnings were actually really good. And I don't think that anybody, including myself, thought that by Q2 2023 earnings would be stellar. Now, I still think that we are going to hit a recession by Q4 of this year, because we've never had these bond yields inverted this way and not hit a recession, right? So I still think we will hit a recession. But I think that, what perma bears don't realize is that the market can actually, go up in anticipation of that so much that once we finally get a drop, it won't be at these October lows. Obviously, there is a first time for everything. I could be wrong on this, but I'm not even making a bold prediction here. I'm just saying, based on data, if we close above this, it would be very weird to revisit these October lows. Obviously, we don't know how bad a recession would be. We don't know if there's going to be a black swan credit event. I'm prepared for anything and everything. And that is why I continue to day trade this market, because I don't have to pick a side beforehand. I can wake up every single day and, pick not even pick a direction, but pick a play regardless of whether it is bullish or bearish based on my criteria. And by the way, speaking of this, we are doing a free mastermind call June 18th, 9 p.m. Eastern time. You definitely want to sign up for this. Spots are almost gone. We have over 500 people on the waiting list. And once spots are gone, they are gone. So make sure, if you are really serious about your trading and you want to improve your game, this is absolutely free. And these are the topics that we're going to cover. My complete day trading strategy guide, how I trade futures, how I trade options, 0 days to expiration. Do you need indicators? How to trade without indicators on your chart, how to draw Fibonacci retracements, and then an Ask Me Anything session where you can ask me whatever it is that you want, and we'll get your question answered. So make sure you sign up for this. Link is in the description below. Spots are almost gone, and once spots are gone, they're gone. So this will be on June 18th. It is absolutely free. Yes, if you sign up, you will get a recording of the mastermind as well. So make sure you sign up there. Now, in terms of sticky inflation, I'm just going to round out with this. I posted this on Twitter, and I said in 1982, inflation was 6.2%. It wasn't until 1986 we got back to 2%. So that's 4 years. In 1990, inflation was 5.4%. It wasn't until 94 that we got to near 2%. So another 4 years. So from this point on, inflation can be very sticky to go from, a 4 or 5% rate back to 2%. And so I'm not expecting this to take, a very short amount of time. However, it is important to note that between 82 and 86, the S&P ran up 100%. Between 90 and 94, the S&P ran up 50%. So you can get a rally during inflation that is, in the single digits, trying to get back down to 2%. It doesn't mean the market has to wait until inflation is down to 2% for it to rally. So I hope you keep that in mind. So that is my take on it. If the Fed does a pause tomorrow, we will be going live 1:30 p.m. Eastern time. Make sure you check that out. We will definitely be going live. But if the Fed actually does a pause, I think we'll get to that 44 to 4,500 range. And then from there, it'll be a wait and see. I do think we can see a retracement, of about 5 to 10% on the market. So, and if you want to follow my trades, if you want to see how I'm day trading this, we've been day trading futures mostly lately because they've been easiest to trade without theta decay, without, any sort of other Greeks, without having to take into account Vega and Delta. I think that day trading futures has actually been a huge success for us. And we took 3 trades yesterday on the Russell 2000 futures. We were 2 for 3 yesterday, and the loss was a 1-point loss. So we keep our losses minimal and try to maximize our gains. Make sure that you sign up if you want access to the academy below, and make sure you have no excuse not to sign up for the free mastermind. Hopefully this was, quick and concise. Hopefully that it was helpful. If it was, leave a thumbs up, leave a comment in the comment section below. Let me know what you think the market is going to do. How are you positioned? Make sure you join us 1:30 p.m. Eastern time on June 14th for the FOMC live stream. And yeah, I will see you guys there. Stay safe out there, traders. Peace.